Hey guys, today I'm going to show you three of the best scalping strategies in 2024. If you are a trader and you enjoy scalping, or maybe you are trying to venture into scalping, this video is for you. Okay, so stay tuned. Click on the subscribe button, like this video, comment your thoughts in the comment section, and just help me to create more content for you guys. I want to create more content for you, but I also want your feedback so that I know exactly what to create. All right. So let's talk about today's uh, today's content, or what we are going to talk about. I'm going to define what scalping is and give you these three methods. And another method, the bonus method, method number 4. And I want you to listen very carefully to this video because I'm going to be going through each method as best as I can. All right. I don't want the video to be unnecessarily long. So I am going to try the best way I can. Just go straight into it and explain some of these methods and how you can use them to consistently profit in your trading. All right. So let's look at scalping. What is the definition of scalping? All right. So scalping generally refers to a trading strategy or methodology where the trader makes small profits, right? Primarily on small price changes. So you're pretty much just taking a much bigger number of trades, but just getting a small profit as you enter each trade. Okay. Now, usually with scalping, you are not holding the trade for a long time. You are holding it for a very short time. And there is really room for you to scalp in assets or pairs that trade in a much more volatile space. I will give a couple of examples. Gold is a good scalping pair, XAU USD, that is. And then the second one would be US30. It's a very good scalping asset. And then for those of you that actually trade on deriv, there is volatility indices, volatility 100. It's a very volatile pair. You can scalp on that. You can also scalp on V75. You can also scalp on many other pairs. It just depends on your risk tolerance, okay? Now, if done well, scalping can be very profitable. I have an account that I scalp on, and it's very consistent. And I'm going to share with you the strategy that I actually use for the scalping. All right. So let's go. So method number 1, the method of non-congested zones. Now, I know a lot of you may not really understand what this means, but I'm going to explain what non-congested zones are and how you can identify them. Right? So non-congested zones are zones in the market that the market will often pass and it will actually ignore. So these are zones that don't really have any congestion in them. Now, I've categorized non-congested zones into 3 and how to identify them. So I'm going to identify them using Fibonacci, and I'm going to explain to you how just now. So let me show you how you can use Fibonacci. So this is the chart for XAU USD, that is gold. I'm going to use the M5 time frame. I don't want to use the M1 time frame for now. I'll explain later, but let's use the M5 time frame. Now, how do you construct a Fibonacci line? Okay. The best way that I have seen for you to be able to really capture proper Fib levels or Fibonacci zones is to have 2 moving averages. So I'm going to put 2 moving averages on this. So insert indicators, trend, moving average. Where is my moving average there? Okay. I'm going to put, for gold, I usually use the slow moving average that I use is the 92. Sorry, the slow that I use is the 23, and then the fast is the 92. So 23 moving average. I'm going to make that red, crimson. Right, I'm going to make that an exponential moving average and apply it to close. But make the line thicker, right? Make the line thicker so that you can actually see. Click on OK there. That's my slow moving average. And then I insert another moving average. Again, indicators, trend, moving average. Oops, sorry. Set indicators, trend, moving average. 92. I'm going to make this one blue. So these are my moving averages. So what do I do? I zoom out and look at this cross over here. So there's two types of crosses in the forex market. There is the dead cross and the golden cross. The dead cross is the one that comes when the market is about to fall, which is this one here, where the slow moving average crosses below the fast moving average, and then that is the dead cross. So when you see a dead cross, you know that the market is going to go down. And then when you see a golden cross, you know that the market is going to go up. Now, what do? I go to the most recent cross. In this case, this is the golden cross. Then I click here where it says draw Fibonacci retracement. I left click on the cross. I continue clicking. I go straight down to the lowest point, or the most recent peak, which is the most recent lowest point, which is there. And then that's it. I have drawn Fibonacci levels. Let me customize my Fibonacci so that it looks much better. I don't want the color to be yellow like that. Okay, so I'm going to change that to the green or something. Let me make it brown. So those are my Fibonacci levels. So what does this mean? I can now tell the points that when the market breaks above, it is going to just move, right? So anytime the market is between this zone here, as you can see, anytime the market breaks below the 161.8 line, there it's going to move. And the next target is the 100 peak level. So I can scalp in between these zones. This is a non-congested zone. The market does not congest itself within this zone, right? This is how you identify non-congested zones. Of course, this is a generalization. You can make use of other tools to find your non-congested zones. So I'm going to explain some of these now in the next section, right? So number 2 item is using psychological zones. So I'm going to look at gold and explain something that has just recently happened and talk about psychological zones. Now, if you look at gold here, this is just a recent, don't worry about the moving averages and all these lines. This is just the recent chart gold. But let me find something that is more. Yeah. Let me just show you something here that happened with gold. Now, gold at this point is at an all-time high. Right? This has never happened before. Now the question is, how do I find a non-congested zone for something that may not necessarily have a form of support or form of resistance? Because remember, your non-congested zone simply means a zone that the market does not um, will not respect, right? The market will always respect its supports and its resistances, but how do you know a support and a resistance on a market that is printing a new price altogether, like gold is doing now? So what you need to do is you need to remember that markets are psychological. There is always, always, always the psychology around the market. And this is about numbers. Now, if the price of gold, say, goes to 2,300, it is bound to be rejected at 2,300. If it goes to 2,350, it is bound to be rejected at that price. If it goes at 2,200, it is bound to be rejected. So if even before gold goes to 2,300, I know that 2,300 is going to be a tough zone for gold to break. Right? That's 2,300 over there. So once gold goes to 2,300, I know I can start scalping for sales, right? And if I look at 2,250, which is somewhere there, I know that if gold goes above 2,250, then the next stopping zone would be 2,300. So it's almost it's not really an exact science, right? It's psychology, remember, but you have to look at things like zones that the market would not necessarily ignore. Look at this. This is 2,200, right? Once the market hits 2,200, you can scalp for sales. If the market breaks above 2,300, 2,200, then you can scalp for buy. So this is how you can identify non-congested zone, method number 2. And method number 3 is going to be using consolidation, all right? So I'm not going to explain much about this. I have a consolidation tool that I made, and I made it available for free. It's on this channel. You can go and check it out. Let me show you a few indicators, right? There we go. I've got my consolidation indicator. Um, oh, it's an EA. I put it as an EA. Oh, it's on MT4. All right. So I've got the tool on MT4. I didn't put it on MT5, but you can make use of that as well, right? It's on this channel. You can go and check it out. It's not an MT5, so I'm sorry for that. But let me just open MT5, MT4, and just show you uh, what it looks like. Um, give me a sec. All right, and while that opens, I can just show you something else. This here is the consolidation indicator. It's unfortunate that at this point it's still loading, so I'm going to come back to it. Right. Let me present here. Okay, so the next thing I'm going to talk about is new scalping. But before I talk about that, let me now show you. I think my MT4 is about to show, so that I can show you this consolidation tool that I created for you guys to make use of. Right. Um, okay. So this is the MT4 tool that I made. I will try and see if I can code the MT5 one and share it as well. But yeah, So look at this. If you look at this indicator here, it shows you where there is congestion. What do you call it? Congestion or consolidation. Yeah, right, with these X's over here. And as soon as the market breaks below that zone, you can actually scalp. So you can scalp this cell over here, and then you wait. You see consolidation again. When the market breaks below the consolidation, you can scalp again. Consolidation, scalp, consolidation, scalp. So it's just a good tool if you want to use it to scalp. Some people also scalp during consolidation phases. So it's something pretty interesting that you can make use of, right? Let's move on because we don't have much time. I don't want this video to be extremely long. Now we have news scalping. Now with news scalping, I have two methods, two primary methods that I would like you guys to know about. And I think it's going to be very helpful that you know about these two methods. Now, you either wait for the spike of the news and then trade, and you trade against the trend. I realize a lot of people, when they see a news release shooting towards a certain direction, they scalp with the trend, which is not going to be helpful because you may hold that trade for a very long time. If you are scalping against the trend during a spike, what you are doing there is you are leaving room for you for the market to come back very fast. Okay, so what the market will usually do is it will spike the high, and then it will come back very fast, and then go back slowly towards the trend. Okay, so if you are going to scalp very fast, spike, wait for the spike, and then trade against the trend, wait for the spike, trade against the trend. Now, the question is, how do I know if the spike is done? Right? So you also need to be able to draw your support and resistance zones. I will do a video explaining some of these things because I realize if I continue drawing in this video, well, let me just draw because in as much as this video could be long, it is also helpful for you to actually see what to do during times of turbulence. Right? So let's say there is a news release and there is a spike. So I'm going to make use of a slightly smaller time frame and show you what is happening. So there we go. Let's say there was news here and the market spiked the low, right? So like I said, you trade buy trades because the market will come back down, but slow. So what you do is the market, there was news release over here, right? But how do you know that the spike is over? What you do is you draw zones before the news release. So before the news release, what you do is you draw zones like this one. This here is a support zone that can be seen from below as a neckline for this head and shoulder pattern on this side, or this double bottom on this side. So you draw a line there, and then you draw another line here. Those are your two lines before the news for the sell. And then when the market sold, it touched this point and then created a small wick there. Just as soon as you see the market touching the neckline there, you know that the spike is over, and then you can start buying. So I would recommend that you make your lines a little bit thicker. So right click on the line properties, and then you go into that, then you make that thicker so that you can have a better chance of catching the spike at the right time. Okay, and then you can buy here, scalp. This is how many pips from here to there. That's about 60 something pips, which if you are scalping 10 pips, 20 pips, you should be able to capture 5, 10 pips here when the market moves, right? So that should not be a problem, okay? So that's number one method when scalping news. The second method is making use of pending orders. Okay, so multiple pending orders with very small uh, take profits and small stop losses. Now, this is a method that I used to use a long time ago, and I didn't stop using it because I did not want to stop. I stopped using it because I created an EA that helps me to do that. So I'm just going to show you what you can do manually. The EA is quite expensive. I've got the EA on sale at 1,050 US dollars. So I wouldn't want to be advertising that here. I want you to know how to actually do that manually. Okay, so what you can do is same thing. You create before the news, you draw your lines of support or resistance or whatever it is before the news, right? And then what do? You have you place a pending order above or below your line. So let's say this is our line. Let's call this line. You create a sell stop here, and you put the take profit for the sell stop to be very small, maybe 5 pips or 4 pips. But instead of making that one trade, you make that 10 trades. I have a tool again, which is your which is what we call the ease order tool that can help you to open multiple trades at one price. So you can have that, and then you can have so the sell stop there, or maybe you can have a buy stop on the other side, buy stop, and same 4 pips TP, and multiply that by 10 trades. Right. So that means you're going to take 40 pips, but in essence, you are taking it as 4 pips by 10. And the market is most probably just going to swoosh through your trades and just open and take profit immediately, right? Of course, you have to be very wary about things like slippage and all of that, which is another concept you need to learn about. But yeah, this is another method of doing that, okay? Always check, right? Before we talk about this, always check if the broker allows you a take profit of 4 pips or 5 pips for that particular pair. And how do you check? You right click on the pair that you want to trade on the market watch, go to where it says specification. It has here where it says it has where it says here top level, stops level. Here. This here tells you how many points or how many pips the broker allows you as a minimum of take profit or stop loss. So it's very important to check that before you actually place a trade for, you know, with a small take profit or with a small stop loss. All right. So let me clear this. And let's move on. All right. Let's move on. I'm hoping now we're about to finish. All right. So last but not least, oh, this is not the last, but this is the third method, which is one of the riskiest scalping methods out there, but it could help in times when the account is about to get wiped. And I really don't recommend this if you're using a very small leverage. But this is very good if you've got high leverage. It allows you to open more trades, and also if you've got good capital. Or if you are trading on volatility 100 1S or volatility 75 1S, this is a good method. All right. What does this method entail? This method simply means you open a normal trade, right? It's a buy trade. You open your trade normally without a stop loss, but you have an accepted zone of loss. So let's say you open a trade and you're saying, I'm willing to take a loss of $40 on this trade. However, instead of taking the loss at the time that the trade reaches minus 40, you open a counter trade. You open opposite position, but of the same lot. So say you have a buy of 0.1, then when it goes and it's now on minus $40, you open a sell of 0.1. Now, a question would come and people will say, but why would I need to do something like this? Well, realize something. Sometimes you may not necessarily know that where the market is going, or you may not necessarily have a good probability setup, but this helps you to not increase your loss or to not increase your losing position. So it allows you to have the time to analyze the market a little bit clearer. In as much as you have a negative 40 loss, that loss will not change as you now have a counter trade, and this will open your margin. Open margin. This is a very important thing to do. It will open your margin up so that you can actually trade, so especially if you had an account that was about to lose. Okay, I'm going to explain this just now. This is a very exciting strategy. Let me show you. So let's say you are trading and you looking at this. This is say a buy trade, and then you are selling. And then the margin that I've used up so far is 149, which means if I try to sell again, I've done so. I've sold again. Okay, let me remove this GBP-JPY. I have used a margin of 45, so I'll continue trading. Let's see, until I have zero margin to trade. Yes, there is no more money to trade, right? However, if I feel like, okay, I no longer have any more money to trade, but my trades are running in loss, or I want to keep I want to lock in the profits that I have so that I can look for a new setup and trade that new setup. What I can do is I can now, these were sell trades. What I can do is now I can buy. I will buy how many? 1, 2, 3, 4, 5, 6, 7, 8, 9. Though it does not allow me to continue selling, it will allow me to buy. Look at this. 1, 2, 3, 4, 5, 6, 7. So 1, 2, 3, 4, 5, 6, 7, 8, 9. 8, 9. So what I've done there is I now have 9 buy trades, 9 sell trades. And what it will do is it will lock in my profits there. Right, as you can see, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9. And so it's 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. Yeah. So I've logged in my profits. As you can see there, the profit will just be going about the same figure there, about the same figure there. Right? It is not changing up or down. Then I can go out. Now what I've done is I have freed up some of my margin. All right. I freed up some of my margin so that I can actually trade. Let's see. What is going on here? Oh, okay. I now have free margin of $18 there. So what I can do is I can go to another pair, and then I can start looking for setups there, and then I can enter trades on those pairs if the margin allows me to. It's just that I've used a slight, this is a problem because I used an example where I have a very small amount of margin, small amount of money in an account. Okay. So yeah, this is how you can use the zone recovery. I now have a zone. I'm holding on to this zone. I can make use of this zone and enter buys or sells in this particular zone while holding a profit or holding a loss. Okay, let me close all of these trades. Okay, so zone recovery is I'm going to do another video explaining zone recovery on its own because it's actually a theory on its own. All right, I'm going to explain it another time and explain the new zone recovery EA that I'm going to publish later on. Okay, then let's talk about the last thing, which is just a bonus thing that I want to talk to you about, which is the peak test or the ADR setup. So what you can do is you can do what is known as the calculation of the average daily range. What do we know about average daily range? Simply means the average range that the market moves through in a day. So if you look at the difference between the lowest and the highest of the previous day, which is this, it's about 46 points, like 460 points or 46 pips. This is for Euro USD. So we have 46 there. And then the previous day, we had how many points? 73 pips. And the previous day, so I can take 3 days. The previous day, we had difference between high and low, about 54. So 54 plus 72. So just come here, let me just do 54 plus 72 plus 36. That's 172. So I can divide that by 3 and say 172 over 3. This is 57 pips. So the average daily range for Euro USD currently is 57 pips. So what does this mean for me? What I will do is I will go to the lowest and mark the lowest of the day. And then if the market is going up, I will say on average, the market is slightly going to move about 57 pips. So I am going to draw my 57 pips. 52, 57, somewhere there. Right click on that. I click where it says trading, put an alert there. What it means is if the market moves 57 pips from where it is now, I can scalp for sales because I know that the market has moved to the highest possible place could for the day. So it's one method you can use, or you can go to the peak of a particular pair. Let me go to the peak for gold here. Let me just put my times separators. Right. What I can do is if I go to gold and I see a peak formation, which is like this one here, this double bottom over here. If I look at a peak formation and I see one, what I will do is I will wait for it to break above the neckline. Then I'll scalp above the neckline or below the neckline, a couple of pips. So if I see a peak like this, above the neckline, I scalp, below the neckline, I scalp, same here. When the market comes back below the previous neckline, I scalp, above the neckline, I scalp again. So these are the 4 methods that I wanted to talk to you about. And unfortunately, the video is quite longer than anticipated, but it's all right. We need to learn, right? So yes, make use of statistics and also customize the strategies, all right? I want to put a disclaimer out there. These strategies may not work for you. They may work for someone, may not work for someone, because for a strategy to work, you have to also be an independent thinker. Think about your own personal situation and what you're trying to achieve. Be an independent thinker. Don't always think, well, he mentioned 4 pips, so I'm going to do 4 pips. What if you want to do 5? What if you want to do 3? Or you want to do 10? Do what you can and what you can afford to do. And then also learn to spend time on one strategy. If you are going to test a strategy, please don't just say, oh, it has failed because you have had 3 unsuccessful trades consecutively. You have to learn to spend time with the strategy and familiarize with what works with the strategy and what doesn't work with the strategy. Have enough data to be able to actually say, oh, okay, so for this strategy to work, I have to do A, B, C, or D. So have big data, okay? And then number 3, don't be quick to shout. Now, don't be quick to say the strategy works. Test it, also have big data. I know a lot of people who say the strategy doesn't work as soon as it doesn't give them profit. But some people, as soon as it gives them profit, they say it works. Doesn't necessarily mean that, okay? You need to have enough data to be able to actually reach a conclusion. But all the same, I guess that's it, guys. Thanks for watching. Subscribe for more content. I know you guys continue subscribing, which is good. All the best in your trading, and this is yours truly, the Complete Trader. Until the next video, share this video. Take care.